Welcome back to the deep dive. Today we're diving into something pretty huge, actually, and that's the brand new Trump tariffs. You've sent us a really incredible set of sources here, really looking at everything, like from the big picture, like economic forecasts, down to like real concerns on the ground stuff. So our mission today is pretty straightforward. We want to figure out the key insights. What do these trade policies actually mean for the markets, for the economy, without, getting lost in like all the little details, right?
Yeah, for sure. You want to see the forest for the trees, as they say, and that's what we aim to do here. So looking at the economic and market shifts that these tariffs are likely to make happen based on what you've shared.
Okay, so the announcement came out April 2nd. They're calling it Liberation Day. Kind of a bold way to start things off, wouldn't you say?
Yeah, it certainly got people's attention.
Yeah. And then almost right away, on April 5th, boom, this baseline 10% tariff comes in on imports from, well, most places, really. But here's where it gets really interesting. Starting this week, April 9th, the administration is putting into place these, what they're calling discounted reciprocal tariffs. And those are aimed at, countries they see as not playing fair on trade, right?
Exactly. And it's important to understand that these reciprocal tariffs, they replace that first 10% for those specific countries they're targeting. And the numbers are pretty significant. We're talking Japan at 24%, the EU at 20%, and then China, they're hit with a whopping 54% in total. That's a new 34% on top of the 20% they were already dealing with. It's a major escalation.
It is. Now, Canada and Mexico, they've got kind of a different situation and maybe tougher in some ways too. They're not under these new reciprocal tariffs, but they are still facing the existing ones, plus these new planned levies, like a 25% tariff on like most imports, and then right away a 25% tariff on cars made outside the U.S. That actually started last night, so the auto industry is definitely on high alert.
Oh, yeah, definitely. This is about pushing for boosting U.S. car production, for sure. And it's worth thinking about all this in context. Historically, the U.S. has had times with way higher tariffs, like back in the late 1800s, and then again during the Great Depression. Now we've had lower rates more recently, even with the last Trump administration. But this is, it's a real shift back to a more protectionist approach.
Yeah, no doubt. One of the reports even said that only like a major market crash or a full-on revolt from Republicans in Congress would make them change course. So that kind of shows you how serious they are about this. So for you listening, trying to make sense of all this, we're going to lay out the big takeaways, the aha moments that really help you understand what's actually going on. Let's start with what this might mean for the economy right here in the U.S.
Well, looking at your sources, one thing that's super clear is economists pretty much across the board, they're concerned that, with these tariffs, businesses are going to have higher costs, and they're going to pass those costs right along to us, to the consumers.
And those potential costs, they're pretty eye-popping. The Yale Budget Lab, they estimate American families are going to be paying somewhere between, $2,400 to $3,400 extra every year. And here's a big thing. It's not going to hit everyone the same. It's really going to disproportionately hurt lower income households, the folks who are already stretching every dollar.
Yeah, that makes sense. And if you look at what happened before, the Peterson Institute on International Economics, they found that those earlier tariffs, the ones on China, Canada, and Mexico, those already cost the average household over $1,200 a year. Now, this time, it's broader, hitting more countries, and the rates are higher in a lot of cases. So that cost, it could easily be, way bigger.
We're also seeing a lot of small business owners. They're pretty worried. I mean, they're getting hit from both sides, right? Their costs are going up for all those imported parts they need, which makes their products more expensive. And then on top of that, people might buy less because everything's getting pricier.
Yeah, you nailed it. And Erica York over at the Tax Foundation, she put it pretty bluntly. She called these tariffs the largest peacetime tax increase we've seen in history. That really puts it in perspective, how big of a shift this is for the U.S. economy.
Wow, largest ever. So some folks are even talking about engineered stagflation late, which sounds kind of scary, frankly. What are these sources even talking about there?
So think of it like an economic slowdown, but with a nasty bite. The worry is that these tariffs, they're going to make imported goods more expensive, and that leads to higher inflation. At the same time, businesses are facing those higher costs. People have less money to spend, and that could slow down the economy. So you get this combo, high inflation and low growth. That's what has economists really on edge.
Uh,
And that could lead to like lower yields on U.S. Treasury bonds, and then the yield curve between the 5-year and the 30-year, that could steepen, which basically means people are worried about growth in the long term.
Yeah, it's a lot to unpack. And, the DBS report you sent, it raises some big questions about like the logic behind all this. They talk about something they call 4 inconsistencies of Trump's model. So what are like the key contradictions they're pointing out?
So they highlight a few big tensions. Like, first of all, you have this push to restrict immigration, which means fewer workers, but they also want lower cost of living. And those two things, they don't really go together, right? Fewer workers can mean higher wages, and that can fuel inflation. Then there's the idea of having tax cuts, but also a lower budget deficit. That's tough to pull off, especially if these tariffs end up slowing down the economy. They also question this idea that tariffs automatically make American companies more competitive. I mean, a lot of U.S. businesses, they rely on imported parts to keep their own costs down. And finally, they say it's not clear how you can have a weaker dollar and lower interest rates at the same time. Because usually, with these tariffs and potential inflation, interest rates would tend to go up.
Yeah, and these inconsistencies, they really make you think about like what they're hoping will happen versus what's actually likely to happen. And then there's this whole other risk, right? Like what if other countries react in ways that hurt the US economy?
Oh, that's a big one. The report even talks about the possibility of other countries propping up their own currencies or even like starting to ditch the dollar for international trade. They say that could really open a massive can of economic and financial worms, basically, like messing up the whole global financial system.
Right. And if we look back, at the actual trade numbers under different presidents, it's interesting. The DBS report shows that during Biden's term, we actually saw increases in total exports, imports, and even the trade balance compared to Trump's first term. That might surprise some people.
It does show how trade is it's this really complicated web of global factors. And policies, well, they can have consequences that you don't always see right away, or they might not even line up with the stated goals. So let's switch gears a bit and look at what's likely to happen for China and Hong Kong, since they're facing these pretty big tariff increases.
Yeah, 54% total tariffs. That's got to be a huge hit to Chinese companies selling here in the U.S. Which sectors are going to feel it the most?
The report points to the smaller manufacturers who make consumer goods. They're the ones making everyday stuff like electronics, clothes, toys, things like that. And they sell at pretty low prices. So absorbing these tariffs, it's going to be really, really tough for them. They might not even be able to compete in the U.S. market anymore.
And we can expect China to push back, right? The sources mention some strong words already.
Yeah, almost definitely. Their foreign ministry, they've already said these tariffs are a serious violation of WTO rules and that China is going to take whatever steps they need to protect their interests. So we should be ready for countermeasures, which could mean tariffs on U.S. goods or, other ways of putting economic pressure on the U.S.
Okay, so zooming out to the bigger picture, could these tariffs lead to like global inflation?
That's a major concern. When you have a big producer like China facing higher costs to export to a huge market like the U.S., those costs, they tend to trickle down to consumers in lots of different countries. And that can slow down the global economy because people have less money to spend.
And the report even suggests that Chinese companies might try to sell their stuff in other markets. Where might they focus their efforts?
Well, Southeast Asia, Africa, Latin America, these are all places with growing demand. Chinese exporters, they might try to establish themselves more firmly in those markets. Those markets might not be as big as the U.S. right now, but they offer potential, and they could help China rely less on the American market. Plus, we might see China building closer economic ties with other countries that are also being hit with U.S. tariffs.
Makes sense. Now, there's also this change coming with the de minimis exemption for small packages. Can you explain what that is and how ending it for China and Hong Kong might have an impact?
Sure. So the de minimis rule, it basically let packages worth less than $800 come into the U.S. without having to pay tariffs or go through a lot of inspections. This has been a huge part of why e-commerce has grown so much, because a ton of these small packages, they come from mainland China and Hong Kong. But the U.S. is getting rid of this exemption for those two places starting May 2nd.
So what does that mean for, like, regular people who shop online?
It probably means higher prices for a lot of stuff people buy online, the things that ship straight from China and Hong Kong. And for the businesses running those platforms, plus the smaller U.S. businesses that import cheap goods this way, it's going to create some logistical headaches and definitely increase costs. It might even make that whole business model less appealing. Some analysts think this could even lead other countries to uh, reconsider their own de minimis rules.
Right. Now, for Hong Kong specifically, the report says the impact might not be as bad as for mainland China. Why is that?
Well, the main reason is stuff made in Hong Kong locally, it's only a tiny part of the total exports. Plus, Hong Kong's role as a middleman, re-exporting goods between China and the U.S., that's been shrinking lately. So there will be some ripple effects, but the direct hit from the tariffs, it's not expected to be as bad as for mainland China.
Got it. And how about the People's Bank of China? How are they likely to handle the value of their currency, the renminbi, with all this uncertainty?
The PBOC, they seem to be focused on stability. They're
Yeah.
expected to take a careful approach,
Yeah.
basically discouraging people from dumping the renminbi, keeping the daily fixing rate pretty steady, and allowing some fluctuation in the dollar renminbi rate within their established band. So they're basically trying to avoid any big drops in the currency's value.
Okay, so zooming back in on China, besides those smaller consumer goods companies, which industries are the most vulnerable to these higher tariffs?
Electrical machinery and nuclear reactors, boilers, and machinery, those two categories together, they make up a whopping 42% of China's exports to the U.S. So those are going to feel it for sure. Other big ones are furniture, toys, plastics, chemicals, textiles, and clothing, and the automotive sector. In general, the average tariff on stuff coming from China, it's going up a lot.
Okay, so let's broaden our view again and look at how this might play out for other Asian nations. The report talks about a regional dispersion of impact. Can you explain why some countries might be hit harder than others?
It comes down to a couple of things. First, how much each country depends on exports to the U.S. And second, the specific reciprocal tariff rate they're facing. Those rates, they vary quite a bit across the region.
And some of those reciprocal tariff rates are pretty surprising, actually. Can you give us some examples of the ones that really stand out?
Yeah, absolutely. So Vietnam's looking at 46%, Taiwan 32%, Thailand 36%, Indonesia is also at 32%, South Korea 25%, Malaysia 24%, the Philippines 17%, Singapore 10%, and India 26%. As you can see, it's all over the place.
So more a country relies on selling stuff to the U.S., the more vulnerable they are, basically.
Exactly. The bigger the share of their exports that go to the U.S., the more their economy is going to feel these tariffs.
So what kind of responses might we see from some of those harder hit Asian economies like Japan, South Korea, and Taiwan?
The report mentions a few possibilities. They might try to import more from the U.S., maybe as a way to smooth things over. They could encourage their own companies to invest in manufacturing facilities here in the U.S. And then there's the possibility of fiscal stimulus to help their own economies and maybe even loosening monetary policy.
Right. Now, India's situation seems particularly interesting because the trade deficit between the U.S. and India, it's doubled, apparently. What's the outlook there with these new tariffs?
The U.S. announced a 26% reciprocal tariff on India. And what's interesting is that in some key areas like iron and steel, pharmaceuticals and electronics, there was already a tariff gap, with the U.S. having lower tariffs in general. So the fact that pharmaceuticals and semiconductors have been excluded from these new tariffs, that's seen as a good thing for India, at least for now.
Okay. And how about Singapore? They seem to be in a maybe a stronger position, right? What's helping them out?
So Singapore, they're facing that lower baseline tariff of 10%, and then they've got the U.S.-Singapore Free Trade Agreement, which helps soften the blow a bit. Now, Singapore does trade a lot with the U.S., but their direct exports, they're not as big as some of their ASEAN neighbors, so they're not as directly exposed. That being said, they're not immune to a potential global economic slowdown. The main things the U.S. imports from Singapore are things like medicines, returned goods, some food products, medical equipment, industrial machinery, petroleum products, and semiconductors.
Gotcha. So looking at the ASEAN 6 region, it seems they're in for a pretty rough ride, especially Vietnam, Thailand, and Malaysia. Why are they so vulnerable?
Well, they've been among the biggest contributors to the U.S. trade deficit.
Yeah.
And Vietnam and Thailand in particular, a lot of their total exports go to the U.S. So they're definitely more susceptible to the negative impacts of these tariffs.
And what about Cambodia? Their tariff rate is it's really high.
Yeah, Cambodia, they're facing a potentially devastating increase with a 49% reciprocal tariff on top of the 10% universal tariff. The total could hit a whopping 59%. It's expected to really hurt their garment sector, which is really important to them. And it could also impact their electronics industry and other manufacturing. This could lead to a lot of job losses, especially in key manufacturing hubs like Kampong Spoo.
Wow, almost 60%. So compared to other countries that rely on garment exports, like how does Cambodia measure up with these new tariffs?
Well, unfortunately, Cambodia is facing the biggest tariff hike among its main competitors in the garment industry, like Vietnam, Bangladesh, Thailand, Myanmar, even though those countries are also seeing increases. This puts Cambodian garments at a big disadvantage, and it could make them, and potentially other Cambodian goods, much less competitive in the U.S. market. And to make things even tougher, Cambodia doesn't have as much flexibility with its exchange rate policy as some of those other countries.
Right. So what's the initial reaction been from the Cambodian government and industry folks?
Well, right now, they're focused on figuring out the full impact. The Ministry of Economy and Finance, they're doing a deep dive into these new tariff rates to see how they can, stay competitive. The Ministry of Commerce, they've stressed their commitment to WTO rules, and they've rejected any claims that their tariffs on U.S. goods are unfairly high. And industry groups like TAFTAC, they're calling for calm, and they're working with the government to figure out what they can do. They recognize it's a serious situation, but they also point out that Cambodia is still competitive with some other countries facing high tariffs. But there's a definite worry about potential job losses, and they're trying to protect their business environment as much as they can. Okay, let's shift our focus to Latin America. Many countries there are looking at that baseline 10% tariffs, but a few have higher rates. Which countries are facing those steeper increases? Guyana has a 38% tariff, Nicaragua 18%, and Venezuela 15%, all higher than that universal 10% level.
And Mexico and Canada, they're exempt from the reciprocal tariffs, but they still have those 25% tariffs on most imports and cars. What's the early reaction been in Mexico?
It's interesting. There seems to be some relief down there, actually, because their tariffs are lower than those on some big trading partners like China and the EU. There's even talk of them maybe benefiting from trade diversion, with some business shifting their way. The Mexican peso actually did pretty well right after the announcement.
But it's not all rosy for Mexico, is it? There must be some underlying concerns.
Oh, yeah, for sure. Even though there's some relief, Mexico is still worse off than they were before these tariffs. There's this feeling that the U.S. going it alone, it kind of goes against the spirit of the USMCA trade agreement, even if it doesn't technically violate the rules. And that raises questions about what's going to happen with USMCA going forward. And, of course, any negative impact on the U.S. economy and inflation is bound to affect Mexico, too.
Right. What about Brazil? Their tariff rate seems surprisingly manageable at that baseline 10%.
Yeah, Brazil getting just the 10%, that was better than a lot of people were expecting. It's probably because their trade with the U.S. is relatively balanced. The markets in Brazil have actually reacted positively, and some see them as a potential winner, relatively speaking, in all this. However, their exports to the U.S., they're still projected to go down overall.
Are there certain industries in Brazil that might be hit harder than others?
Yeah, the ones where the U.S. is a major buyer, like iron and steel, aircraft, and ethanol, those could face bigger challenges.
So what's the overall feeling in Latin America about these tariffs?
There's definitely a general unease, and you see more emphasis on diversifying trade, not relying so much on the U.S., especially for countries where China's already a big trading partner. The uncertainty in the auto industry for Mexico and Canada, that's a big worry too. And you hear people making comparisons to the Smoot-Hawley Tariff Act, that was back in the Depression. There's a real fear that this could turn into a full-blown trade war.
Right. Finally, let's talk about what this all means for the financial markets. The report says we could see dispersed performance globally. What would that look like, practically speaking?
Well, we might see the really strong performance of the U.S. market, compared to other markets that might be coming to an end. And you might see stronger performance in places like Japan, Germany, even China, as investors look for opportunities outside the U.S.
Okay. And the bond markets, any big changes expected there with yields?
Yeah, we might see yields going in different directions in different places. In the U.S., with the worries about slower growth and potential inflation, you might see Treasury yields going down and the yield curve, that could steepen. But over in Asia, where the concern might be more about slower growth without as much inflation, you might see yield curves steepening as those countries potentially turn to monetary easing and fiscal stimulus.
Got it. So lower interest rates are expected in China and Hong Kong if they go the monetary easing route. What's going on with Chinese government bond yields right now?
Both short-term and long-term Chinese government bond yields, so we're talking 2-year and 10-year, they've both recently broken through resistance levels. Looking ahead, people are expecting a flattening of the yield curve over the medium term, although there might be some tactical steepening in the short term. Real borrowing costs in China, they're also quite high right now.
And the report also mentions a potential increase in the offshore premium for the renminbi exchange rate. What's behind that?
It's mainly because of the expected volatility in the renminbi's exchange rate and just the overall perception that the currency's weak, given all this trade stuff going on.
Okay. And how about the credit markets? Could we see those risk premiums widening?
Yes, definitely possible. Credit spreads could widen for both, higher rated corporate debt, what they call investment grade, and then lower rated debt or high yield. Basically, that initial market optimism, it might fade away as people start to really understand the economic impact of these tariffs.
Right. So Asian currencies in general, they're seen as more vulnerable to all these trade tensions, which makes sense. And it sounds like China's approach to managing its currency against the dollar, it's pretty much in line with what they've been doing lately.
Exactly. The People's Bank of China, they're expected to keep managing the dollar renminbi rate within a fairly stable range for now. They don't want people making big bets against the renminbi, and they're allowing more controlled ups and downs within their established trading band.
Okay. So the foreign minister of Singapore, he had a pretty dramatic take on all this. He said a new world order is taking shape. Based on these sources, can you break down what he means by that?
Yeah, his speech, it basically paints a picture of a really fundamental shift away from a lot of the ideas that have shaped the world since World War II. So we might be moving from a world with one dominant superpower to one with multiple centers of power, from free trade to protectionism, from countries working together, what they call multilateralism, to countries acting in their own interests, unilateralism, from globalization, which is the world becoming more interconnected, to a stronger focus on national identity, what they call hyper-nationalism, from being open to outsiders to being more suspicious of them, xenophobia, and from like a generally optimistic outlook to a more pessimistic one. And there's this concern that the world could break up into competing blocs led by the big powers, and that would really strain the existing international order, the rules-based system we have.
So this is about way more than just economic policy. It's about a fundamental reshaping of global politics and relationships.
Absolutely. The report talks about the risks of economic fragmentation, geopolitical instability, a weakening of international institutions and big powers, using things like tariffs, financial systems, and technology as weapons. That could really erode the sovereignty of smaller countries, make it harder for them to stay independent and protect their territory. And it could make existing flashpoints like Ukraine, the Taiwan Strait, and the South China Sea even more dangerous. Plus, it could make it much harder for us to tackle global challenges together and protect shared resources.
Yeah. So what are the key events we should be watching for in the very near future?
Well, the expectation is that we'll see some retaliation from those countries that are being hit with tariffs, and that'll probably happen fairly quickly. But there's also a chance that we could see some initial negotiations, countries trying to talk things out, and that could start as early as next week, ahead of that April 9th deadline when those reciprocal tariffs are set to kick in. How those early interactions go, that's going to be really important for how the markets react.
This has been a really insightful deep dive into these new Trump tariffs. It's clear that this has the potential to change a lot of things, trade patterns, consumer prices around the world, and even the global political landscape.
Absolutely. The sources you share, they make it clear that these Liberation Day tariffs, they could really shake things up. They could change how trade flows. They could impact what consumers pay everywhere, and they could reshape geopolitics. We've talked about the immediate effects and what we expect to see in the near future, but the long-term consequences, those really depend on how other countries respond and whether policies change down the line.
So as you're thinking about all this, here's a final thought. Given how interconnected the global economy is and what we've learned from past trade wars, what unintended consequences might these Liberation Day tariffs have, and how should we prepare for this time of major uncertainty in the global trade landscape? It's something to watch closely and think critically about. Thanks for joining us for this deep dive.